Hey, what is up, Satsmate Stackers? Today I'm going to talk to you about stagflation and unemployment and how the Fed is in a really, really hard place right now. Now, we're starting to see the labor market cool significantly. And what's going to end up happening is if things start to worsen month over month and as the 6 months and the years go on, we could actually enter a recession if we're not already in one. And so we all know that the data is completely cooked. The expectations in August were 75,000 jobs, and only 22,000 jobs were added. And these were in sectors like healthcare, primarily. So it's just one of those things where we know that the data is cooked, and if they're telling us 22,000 jobs were added, it's probably like we didn't have any jobs. In fact, we are at a net loss for the month of August. So we're at a 4.3% unemployment rate. A couple years ago, we were at like 3%. So it's definitely ticked up higher and it keeps ratcheting up. And something to notice about that is, again, these are government provided numbers. Just because the government says it's 4.3%, take that with a grain of salt. Because if you're not searching, if after 6 months you're not looking for a job anymore, you're not counted in the unemployment rate. So I think it's a faulty metric, to be honest with you guys. I think it's much closer to like a 15 to 20% unemployment rate. But the way they cook the books to make things look good, it's saying that we're at 4.3%. Now, very, very interesting is this. There was a downward revision of almost 1 million jobs from April 2024 to March of 2025. This is absolutely insane, guys. Almost 1 million jobs. That's almost 100,000 jobs per month that were just overstated, that were incorrect. So this is just insane what the Biden and the previous administration did to say, hey, look at how rosy things are. Things were never rosy. The labor market has been weak from 2024 to present, and it's only getting worse. So a lot of the jobs are coming into the healthcare sector, which is great, right? But something to keep in mind is the healthcare sector, it's due to aging demographics. Our population's getting older. A lot of the boomers are starting to have more health complications, stuff like that. So there's a lot more healthcare related jobs. But other industries like business and or just professional services and finance, they're not doing as well at all. Same thing with tech. Every day you go on the news, you'll see massive layoffs with Salesforce, massive layoffs with Microsoft, massive layoffs with you name the company. So it's a little concerning to see how things have been trending on the labor market front as well. Now, the layoffs, they actually surged to about 86,000, up from 62,000 in July. So we're seeing both the layoffs increase, we're seeing the job numbers decrease, and we're seeing the downward revisions increase significantly. So again, things are not looking too good from the labor market standpoint. Not a lot of people are hiring, and when they are hiring, it's in some fields that are a little bit more specialized. So what's interesting about this whole thing, though, is inflation is on the rise. Inflation is on the rise, and it's one of those things where the Fed has their 2% target, right? And if inflation's rising and people are calling and demanding for a rate cut, what's going to happen to inflation? If inflation has been rising without rates coming down, what's it going to look like with rates lower? So the next thing is, too, about tariffs. Tariffs are increasing the input costs, which could potentially be inflationary, because if you're paying, if the importers, if the companies need to pay 25% more, they're going to pass that along to the consumers. And it's going to cause the prices to go higher. And when the prices go higher, that will impact the cost of goods. So higher tariffs, higher input costs, And also, the deficit spending is really what's driving the inflation, from my view. They're not actually printing more money and giving it to people like you and me. They're rather, the country is going deeper and deeper into debt, and it's becoming unsustainable as we speak. So here's the thing: inflation is about 3.1% that they're stating. I think it's closer to 5 to 10%. The thing is this, though: if they cut the rates, what will happen to your cash savings, to your bonds? Those will lose value. I think gold, silver, and most importantly, Bitcoin, these commodities, these assets, they won't get debased by money printing and by deficit spending and by tariffs. We need to return to a hard money standard. I think all this money that you're seeing right now, all that you're seeing, a lot of money in cash, money market accounts, etc., that stuff will flock into Bitcoin, into gold and silver. Because when the rates drop on those money markets, people are going to reallocate that capital towards other avenues. And it's not going to sit in cash, I'll tell you that. Especially with the dollar going to near all-time lows, and especially with rates being down. What's the point of holding dollars when we know there's an inflation rate? So I think this money is going to have to find a new home, and it's going to find a home in these asset classes I mentioned. I do think another concerning thing is, like, a lot of wages are going up, but they're not actually keeping up with the real rate of inflation. So you're seeing a lot on these reports, like, look at, payrolls are up 0.2%, 0.1% for the month. Yeah, but inflation's up 0.4%, right? So it's like, it's not keeping up with the rate of inflation. And so that means consumers will get squeezed, and they will have to take on more debt potentially. Do you actually think a company will give you a 10 to 15% increase? That's what I think the real rate of inflation is closer to. Do you think they will give you that? I don't think they will. And I do think that's why Americans, they're going to start to become more hand to mouth shortly, because they're not keeping up with the rate. Also, something to think about is the Federal Reserve's independence. So Trump has been calling for lower rates. Trump even has met with Jerome Powell, but you got to start to ask yourself, if the Fed lowers rates, did they do it to meet their dual mandate? I don't know. I could make the case not so. Or are they going to be valuing the employment rate more so than the inflation rate? So I think it's really interesting right now, and if the Fed does a huge rate cut, I think it's safe to assume, I mean, we've all known this, but it's safe to say that they're completely non-independent. They're just one big group. They should just merge the Federal Reserve with the Treasury. And I think this is why we need to protect ourselves with hard assets. Because now more than ever, they're going to keep debasing your life energy, your currency, your dollars, to suit their interests. The currency will always continue to debase, dollar dominance will go down, and the fiat experiment, as we're all aware of, is starting to accelerate to the end. This fiat experiment, it started when we got off the gold standard in 1971, and now we're really at the tail end of it. I mean, the Federal Reserve System was created in the early 1900s in Bretton Woods in 1944, and we're taking off the gold standard in 1971. Things are not getting better for people. You need both people in the family to work now. You need, to send someone to daycare, like your kid. It's thousands of dollars a week, right? And who can afford that? Who can afford to pay groceries and to, grow up with the same things they had growing up? So I think we're in a situation now where we are going through a big change, and it's going to get rough. I think the people that will come out ahead are those that buy hard assets, and those that sit in cash and money markets, they will lose. I think, unfortunately, the Fed has they're between a rock and a hard place. I get it. If they lower rates, inflation will tick up. If they increase rates, markets will crash, unemployment will increase. If they keep things the same, I think both will happen, where we'll see higher inflation and we'll see things crash. So I think it's just an interesting situation where they have no way out, and I think the only way they see out is by fire, not by ice. And I think they're going to continue to print. Things will heat up, and I think people that are on fixed income, people that work minimum wage, people that don't hold assets, they will get left behind. And that's the road that I think they'll take, unfortunately. But don't like go against the way that the tide is. Just accept it and allocate accordingly, right? Like, I don't like how the dollar is losing dominance. I don't like how inflation's going up. But because of that, I'm not going to sit there and woe is me and complain. I'm going to allocate my capital to protect myself, and that is Bitcoin. I think it's unfortunate what the Fed has done. I think Gen Z, Gen Alpha, millennials, we need to go and create a new system, and I think we've done that, and we are working towards that, but it's just going to be a rough couple months and couple years, and we need to prepare and we need to work towards a better outcome. So overall, guys, my thought is not super rosy, but I do want to say this. There is escape hatches. There is things we can do. And those are the commodities I talked about. And overall, I hope you guys stay safe. Make sure to hug a loved one. And I think we can get into a better place if we can make it through this. So anyways, comment, rate, subscribe, like. You guys are the best. And I'll catch you guys in the next one.